ETF Explained, the most powerful investment tool used by the wealthy. Want to invest in the stock market but struggle with picking individual stocks? Here's one of the strongest weapons in the investment world: ETFs. What are ETFs, and how do they work? Let's break it down. What is an ETF? An exchange-traded fund, ETF, is an investment vehicle that pools together various assets, such as stocks, bonds, or commodities, and trades on stock exchanges like a regular stock. ETFs allow investors to gain exposure to a diversified portfolio with just a single trade, making them a powerful tool for portfolio diversification. How do ETFs work? ETFs are structured to track an index, a sector, or a specific investment strategy. They can be classified into two main types: one, passive ETFs, index ETFs. Definition: these ETFs track an index, meaning they hold the same stocks as the index they follow. They are a cost-effective and low-risk way to invest in the stock market, designed for long-term investors seeking steady growth. Examples: SPY ETF tracks the S&P 500 index, top 500 U.S. companies. QQQ ETF tracks the NASDAQ 100 index, tech-heavy stocks. VOO ETF, Vanguard's S&P 500 ETF, lower fees than SPY. Advantages: low fees. Expense ratios are usually very low. Transparency. Investors always know what stocks are in the ETF. Long-term growth. Stock indices tend to rise over time. Risks. If the market declines, the ETF also drops. Lacks active management, which means missing out on market opportunities. Best for long-term investors, 10+ years investment horizon. Those who don't want to pick individual stock, passive income seeker, 2 active ETFs. Definition: actively managed by investment firms. Portfolio managers decide which stocks to include based on a specific strategy, similar to hedge funds but traded like stocks. Examples: RKK ETF, ARK Innovation ETF, focuses on disruptive tech companies. DIVO ETF, Amplify CWP Enhanced Dividend ETF, includes high-dividend stocks. JEPI ETF, JP Morgan Equity Premium Income ETF, uses dividend and option strategies. Advantages: flexibility. Portfolio managers can adapt to market conditions. Higher growth potential. Focus on high-return opportunities. Customized strategies. ETFs designed for specific themes, e.g., green energy, dividend growth. Risks: higher fees. Management costs are higher than passive ETFs. Management risk. Poor decisions by managers can lead to underperformance. Best for investors seeking higher returns. Portfolio management. Investors with specific investment goals.